Hi everyone, welcome back to Atrium Research's YouTube channel. Today I have the pleasure of interviewing Jean-Francois Boursier, CFO of ADF Group, which trades on the TSX under the symbol DRX. We initiated coverage on ADF back in October with an $8 target, which was increased to $9 and then $10 on the recent developments from the company. Our thesis in ADF surrounds around the fact that the company is entering a growth cycle due to infrastructure and non-residential construction spending across North America. The company has also experienced significant margin expansion over the last year due to the automation at its Quebec facility. ADF also has a clean balance sheet, is family owned and operated. The stock has performed tremendously well, up over 70% since our initial report, yet the company still trades at a cheap less than 5 times forward EBITDA. JF, thank you for being here today.
My pleasure.
So for those that are unfamiliar with the story, JF's going to kick it off with a brief company overview, and then we'll move on to some Q&A.
Thanks, Nick. Yes, ADF Group has been founded a little less than 70 years ago, went public in 1999. We are a steel fabricator, one of the sole remaining steel fabricator in North America that's still public. We are doing complex structure, fast track projects in the industrial, commercial, transport. We're pretty much covering all the different sectors of the construction industry. We've got 2 fabrication plants. Our main plant and head office are in Terrebonne, just north of Montreal in Quebec, in the province of Quebec. 630,000 square feet of covered space. We also have a fabrication plant in Great Falls, Montana, smaller plant, but still 100,000 square feet. We also have paint shops at industrial coating shops at both our facilities. We have marshalling yards in Florida and California. We're obviously with these assets, we're able to cover projects anywhere in Canada and US efficiently. And I've grown. The Great Falls plant has been operational since probably 8-9 years ago, and obviously with the 2 plants now and the automation you mentioned just a couple of minutes ago, obviously we've made huge investment over the past few years to make sure that we keep our operation not only up to today's standard but as efficient as possible. So in a nutshell, that's who we are and what we do. Historically, just maybe to end, although we're covering both the Canadian and U.S. market, the Canadian and U.S. market historically, around 85% of our top line has been coming from U.S. project, which is obviously a market that's more in line with the type of projects we do, which are bigger in size, more complex. So the U.S. market is really both fabrication shop is really the market that drives our top line.
Perfect. Okay. Thank you for the overview. A couple questions. So firstly, you guys have built up a really nice cash balance here over the last year. So moving forward, how do you think about capital allocation between maintaining a strong working capital position to take on new projects, as well as increasing the dividend or buying back stock?
Yes, obviously with especially this year's cash flow generation, the question is, it's a good question. As through the years, and obviously we're still trying to grow our backlog, although we're happy with the recent upward trend. But growing the backlog requires a lot of working capital. To start a project, you need to obviously get the steel in. Steel mills payment terms are pretty aggressive, so growing the backlog puts a lot of pressure on working capital. So historically, and over the past few years and quarters, we've been pretty, let's call it conservative from a working or a cash management standpoint. But obviously, the past year's investment, the market, and what we've been able to create from a backlog growth standpoint is paying dividends now, and we're seeing free cash flow generation. So looking forward, and we have internal discussion about cash usage and also discussion with our board. Obviously, we will need to sue because if things continue to go, they've gone this year, and we expect them to do so. We will fall in actual cash, excess cash, and the question will become even more relevant. So, yes, we are looking at increasing the dividend, maybe buying back some shares. There's always the possibility of also reimbursing some debt. We're comfortable with the debt level we have now, but we could reimburse some debt sooner than the expected terms. We're happy with the assets we've got. There's no, at least for the time being, short midterm, there's no acquisition or significant capex expectation. So dividends, normal course issuer bid, unless something pops up that's not on our radar now, that's probably what we'll be looking into in the next quarters and years.
Understood. And with all the backlog growth we've seen over the last year, what's the current capacity of ADF in terms of revenue? And if need be, can you guys expand the Quebec facility to service some of that increased backlog?
Yeah. Obviously, our backlog has grown, but it's not a backlog. When we sign contract, usually our contracts include not only fabrication, but also installation, raw material, and engineering and design. So although our backlog will probably be around the 400 million threshold and even higher, it's not all fabrication. So presently, although our Terrebonne shop is probably a bit busier than our Great Falls plant, we still have room, we still have capacity. So it's not a short-term issue. We have room to grow with the facility as they are. If we were to add more fabrication, we do have room to grow at both our facilities. So we could expand, add fabrication base both in Terrebonne and in Great Falls without having to seek a new facility. So we could expand. Obviously, you not only need to spend the dollars, but it's not these fabrication bays don't come up instantly. But we've added a fabrication bay with the automation investment we did in Terrebonne 2 years ago. And we still have room to, as I mentioned, add fabrication capacity at both locations should we need it.
Right. Okay. And staying with the automation capex, over the last couple of quarters, we were talking more about optimizing that equipment and taking full advantage of that capex in that program and learning how to use the equipment most effectively. Would you guys say you're fully optimized now, or is there still some more upside?
I think we've pretty much taken everything we can out of the robot. Are we 100% efficient, and can we still tweak it a bit? I think we can. It's not just a matter of the robot and the automation. It's also the entire workflow. We've had to learn with different process for not only before but also after the actual work done by the robots, and that we are continuing to improve. So are we totally done from an efficiency gain standpoint? I think we probably can squeeze some percentage out of our new automation setup. But the last year and a half has seen a lot of improvement. So I think that I'm not expecting as much improvement going forward, but I wouldn't say right away that we've fully gained all we can out of our new automated equipment.
Okay. And then with the Montana facility, is there still potential for automation there? I know you said before that it's more specialized work done at that facility, but how are you guys thinking about that?
We're still looking at it, obviously learning from what we've done in Terrebonne. It's not a the entire automation process has taken a lot of time. We spent probably 2-3 years before doing the investment, making sure that it would make sense from our Terrebonne shop. There's the installation and then the ramp up. So to do this, even though we've done it and it definitely paid dividend for us consolidated, and especially in Terrebonne, it is still a complex investment. So obviously we're gaining knowledge. We are seeing what it brings to our efficiency in Terrebonne. As you mentioned, the product mix is a bit different in Great Falls. They do a bit, historically, they've done a bit more complex work. And the more complex fabrication doesn't go through the automated. It still has to be done manually, if you want, with our workers. So considering all of that, we're still looking at it. We haven't decided yet, and it's not on our short-term radar, but still doing the overall analysis, and we haven't decided yet exactly. One thing for sure, just considering the size, if we were to automate in Great Falls, it wouldn't be the same size or same capacity as the equipment we've put in Terrebonne. But they're obviously, considering the workforce requirement and the challenges of getting the number of employees we need, just considering the labor market, automation is obviously a way to solve that issue, so that some automation could be looked at going forward in Great Falls. But we haven't made any significant or any decision for a more significant investment yet.
Great. And then shifting over to margins, we saw 22% EBITDA margin last quarter, scaling up sequentially nicely. How should we think about that in terms of that further improving as you guys hit operating leverage, or is 22% kind of a good steady margin we can look forward to?
I'd like to think that it's a good steady margin going forward. As I mentioned, we squeeze everything out of our new equipment in Terrebonne, probably not, so there might be some efficiency gain. But besides the automation, then you need to look at each project actual pricing. Overall, we've seen pricing improvement in the market. All markets, east or west, especially in the US, are not the same. There's still some pressure on project pricing, if you want. But overall, we're still seeing a good volume. We're still seeing good potential. So obviously, the more volume there is, the less capacity. That obviously helps from a pricing standpoint. So long story short, to go back to your question, I think that the margin we've been able to produce over the next quarter we should be able to keep them in the same range, hopefully increase them in coming quarters, unless and again, depends on each of the projects we sign. But from an efficiency standpoint, I definitely don't expect to see the same upward movement that we've seen over the past year just from the automation gain. So as a step up perspective, I don't think we should expect to see the same type of growth next year, but we definitely want to keep the margins at the level they're at now.
Right. Got it. And then moving over to the backlog and the growth we've seen, you have a couple of major tailwinds helping you guys out with government infrastructure spending, the 2028 Olympics, and so on. So how long do you think this cycle can last for infrastructure and non-residential construction?
Well, based on what we're seeing, and in spite of talks of recession and what have you, we're still, at least presently, still seeing lots of projects coming on stream. In the US, the infrastructure packages are barely starting to be utilized. There's still a huge infrastructure deficit from a construction standpoint. There was even one pre-pandemic, and it hasn't gone better. So there's a lot of work to, as you mentioned, the Olympics are coming. We do see a lot of overseas fabrication or manufacturing being brought back to the US, so that also drives that market. So at least for the time being, what we're seeing from that perspective would translate into probably a couple of years of steady, of good volume. Obviously, in parallel, there are some outside factors that could have an impact. There will be a U.S. election in November. You've got conflicts in Russia and Ukraine, Palestine and Israel. So these are obviously things that could have directly and indirectly an impact on our clients' confidence on the market. So these are the unknowns, but this is nothing new from at least a construction industry perspective. There's always, we know we've got cycles, but the fundamentals, at least the way we see them, are still looking good. In parallel, we see market analysis where some construction trends then seems to be steadying. But again, it's going to be a matter of people want there are significant projects still being put forward. So we're trying to do as much as we can. As I said, we're happy with the backlog we've got now, but with the quarterly revenues we have, the backlog tends to go down quickly. So it's not like we can actually sit back and enjoy our backlog. It's a constant challenge to keep it at the existing level to make sure we've got sufficient hours in both our shops. So we'll keep plugging at it, but at least for the time being, the outlook is still positive.
Understood. And then lastly, back when we initiated on ADF, there wasn't any institutional shareholders. Since then, stock has ripped and the volume has increased even more significantly. So are we starting to see institutions getting involved?
Well, I'm definitely getting more calls. Obviously, with the market cap going from below 100 million to above 300 million, we're obviously getting on the radar of firms that were just not looking at us. I'm getting calls from investors that used to call me probably 12, 14 years ago. So we've definitely seen more, I'll definitely receive more calls. There's definitely more interest. Still no formal deal or nothing significant has materialized. But we're definitely seeing more foot track around our stock. So it's encouraging. Obviously, a year ago, trading below book, as I've mentioned before, it's not like we're losing sleep, but it was a bit disappointing not seeing everything we're trying to achieve being recognized. But we're definitely happy with the growth we've seen and the share performance we've seen since last April, probably, and the growth. Obviously, I think still room to grow. But for us, share price is nice, but we're keeping the mindset on delivering high quality, on-time product, making sure that we have a strong backlog growth, but not with contracts that we're not comfortable with. We haven't changed our approach. We're still really conscious of risk. So we have a backlog, but we've got a backlog that doesn't include too much risk. So we'll keeping the approach that brought us to where we're at now, and focusing on meeting client expectation and delivering quarterly results that are improving and generating cash, so that our shareholders finally get rewarded for their patience. So that's what we're looking at.
Absolutely, yeah. Focus on the fundamentals, and the stock price will follow. Well, those were the only questions I had left. Is there anything else you want to add?
Yeah, maybe one quick point. A week ago today, ADF's founder, Mr. Giacomo Pasquini, passed away. He was 99 years old. Mr. Peskin not only founded the great company we all love, but also touched so many lives throughout the almost 70 years of existence of ADF. He will be missed. So
I appreciate that, and our condolences go out to the team.
thanks.
And amazing. So Jeff, thank you for walking us through the company overview.
My pleasure.
Giving us some of the updates. We're looking forward to seeing the upcoming releases, including the quarterly financials and new contract announcements. For our followers that haven't seen our research on ADF, you can find it all on our website, atriumresearch.ca. And again, thank you for your time, JF.
Thanks, Nick.